Okay, let's dive right into this. If you've been searching for a way to cut through the constant overwhelming noise of the financial markets, you are in exactly the right place. Today, we're going to master a highly reliable, completely rule-based swing trading approach. In this explainer, we're breaking down the market structure and supply and demand swing strategy. Look, this isn't about getting lucky. It's about building a really robust framework, one that filters out all that chaotic minute-by-minute market noise so you can focus entirely on high-probability setups.
So, here's our roadmap for today. We've got 5 main parts to cover: the trap, the map, the trigger, the math, and finally, the execution. Let's get right to it. Phase 1, the trap, escaping the retail mindset. Now, you might be wondering, why do 99% of retail traders fail? It's a staggering statistic, isn't it? Why do so many incredibly smart, capable people deal with the endless frustration of inconsistent results? You know the feeling. Constantly getting stopped out just before the market moves exactly where you predicted it would go? Well, the answer actually lies entirely in how they interact with price. Notice the stark contrast between these two mindsets. On the left, you've got the typical retail trader. They're emotional, they constantly try to predict what the market's going to do next, and honestly, worst of all, they chase price when it's already moving. Now look at the right side. The institutional smart money trader is incredibly disciplined. They're reactive, not predictive. They don't chase anything, they just wait patiently for price to enter their predetermined zones. If you take away anything from this explainer today, let it be this: we absolutely need to stop predicting and start reacting. Let's move on and see how this builds into phase 2. The map, identifying trends and key zone. Step 1 is to identify the main trend. And look, we do this strictly on the 4-hour or daily charts. Remember, we aren't predicting direction here, we're just following it. Market structure is beautifully simple if you just zoom out a bit. An uptrend is literally just a series of higher highs followed by higher lows. A downtrend, just a series of lower highs and lower lows. If the structure is printing higher highs, you look for buys. If it's printing lower lows, you look for sells. You're just seamlessly aligning yourself with the dominant flow of capital. Now, what's really interesting about this next part is once we know the trend, we have to find our zones. Let's start with a demand zone. This is an area where the price strongly moved upward in the past. Honestly, these zones are the literal footprints of smart money. They almost always contain heavy institutional orders and massive pockets of liquidity. When you see explosive, really large candles suddenly launch out of a specific area, that origin point, that's your demand zone. On the flip side, we have a supply zone. This is an area where price strongly dropped before, which signals heavy institutional selling. Drawing these supply and demand zones correctly is step 2 of our map, mainly because these are exactly where the high probability turning points are hiding. We don't want to trade in the middle of nowhere, right? We only want to do business at the edges where supply and demand are wildly out of balance. Okay, moving to phase 3, the trigger, the art of patience. Step 3 is literally where most traders fall apart. You have to wait for the pullback. I'm going to say this as firmly as I possibly can. Never, ever chase price. If you miss that initial explosive move, just let it go. Wait for the price to retrace back into your map demand zone during an uptrend or your supply zone in a downtrend. Waiting for this pullback is the whole secret. It's what gives you a vastly superior risk to reward ratio. You're entering exactly where your risk is the smallest and your potential reward is the absolute greatest. But hold on, we don't just blindly buy or sell the second price taps our zone. Step 4 is entry confirmation. We're going to wait for a specific signal to prove the zone is holding. This could be a bullish or bearish engulfing candle, a long rejection wick, a break of minor structure on a lower time frame, or maybe a liquidity sweep where price fakes out retail traders right before reversing. Waiting for these specific confirmations filters out bad trades and essentially keeps us from trying to catch a falling knife. Contrast these two approaches for a second. Entering exactly as the price crashes into a setup, that is the classic retail trap. But waiting for the market to actually prove it's rejecting the zone, often by sweeping liquidity first, now that is the smart money move. Smart money always waits for the market to tip its hand before pulling the trigger. Let's shift gears to phase 4, the math, the true holy grail of trading. So the crucial point here is this exact ratio, 1 to 3, risk to reward. As a hard rule, you should be aiming for a minimum 1 to 2, or ideally, a 1 to 3 risk to reward ratio, while strictly only risking about 0.5% to 1% of your total capital per trade. Frankly, this math right here is what separates the long-term professionals from the gamblers. I absolutely love this quote. Your stop loss is a seatbelt. You don't put it on because you expect to crash. You put it on because if you do, you survive to drive again. Let that sink in. Capital protection must always, always be your first priority. You simply can't grow a trading account if you blow the whole thing up on a single bad trade.
Now, this brilliantly illustrates a fact that actually shocks a lot of beginners. With a strict 1-to-3 risk-to-reward ratio, you can literally lose 70% of your trades, and your account will still consistently grow. No way, right? But it's true. You don't need to be right all the time. You just need your math to be right. A 30% win rate is entirely sustainable if your winners are 3 times larger than your losers. All right, bringing it all together in Phase 5, the execution, your daily workflow. Here is your highly disciplined, repeatable, everyday action plan. 1. Mark your main trend on the daily chart and draw your supply and demand zones. 2. Sit on your hands, wait for the pullback to your zone, and then look for your entry confirmation. 3. Enter the trade with a strict, proper stop loss to protect that capital. And 4. Set your target at the next major liquidity area. Then you just rinse and repeat. Let's break down multi-time frame analysis real quick. You use the daily or 4-hour chart for your big picture trend direction. But, and this is key, you don't enter there. You zoom way into the 1-hour or 15-minute chart to hunt for that precise entry setup and confirmation. And because this is a swing trading strategy, your holding time is generally going to be anywhere from 1 to 10 days, just letting those larger market structure moves organically play out. Now, a super quick note on indicators. While things like the 50-period exponential moving average, which mathematically is just tracking y equals the 50-period EMA of your recent price data X, can help you quickly gauge trend direction, and tools like the RSI or volume can help confirm momentum, the golden rule is this: keep your charts clean. Seriously, do not clutter your screen. You have to prioritize naked price structure and those supply and demand zones above all else. So, where do we actually apply all this? Well, here are some of the absolute best markets: gold, major Forex pairs like euro-dollar and pound-yen, indices like the NASDAQ 100 and US 30, and of course, major crypto like Bitcoin. These specific markets are fantastic for this strategy because they have tons of liquidity, they move cleanly, and they respect market structure incredibly well. Before we wrap this explainer up, we absolutely have to talk about the ultimate test of your trading psychology, the golden rules. First, trade with the trend. Second, don't overtrade. Listen, boredom is not a valid reason to enter the market. Wait for clean setups. Always protect your capital first. Journal every single trade so you can actually learn from your mistakes. And finally, focus on consistency, not excitement. Honestly, good trading should actually be kind of boring. I'm going to leave you with this powerful final thought. A strategy alone is never going to be enough. Understanding smart money concepts and liquidity is fantastic, but rigorous, unwavering discipline is what actually makes swing traders profitable. The market will always test your patience long before it rewards your technical analysis. So my question to you is, are you ready to stop predicting the market and start reacting to it? Let that sink in. I highly encourage you to pull up some charts right now and start mapping out those zones today.